of debenture. So in redemption of debenture, we are going to learn on how do the company wants to redeem their debenture. Okay. So recall in chapter 3, okay, debenture is a type of debt. So it is classified under liability. Remember in chapter 3, the company issue debenture to raise its capital. So the capital here is actually comes from the issuance of debenture. So now, okay, in chapter 4, we are going to learn on how do the company redeem its debenture. So this debenture is actually a loan made by third party to us. So we have an obligation to repay the loan. So the repayment of debenture is called as redemption of debenture. Meaning the company will make a payment to the debenture holder at a future date. So the date will be determined once the company issue the debenture. Alright. Another thing that we need to know is the debenture holder. So the debenture holder is referring to the people, okay, to the person or institution, okay, who lends the money to the company for a fixed time and a specified interest rate. Okay. So now, okay, in chapter 4, we are going to learn how do the company make the redemption. Redemption here meaning we are going to repay the money. So we are going back the money to the debenture holder. So how to make the redemption? Okay, the company will refund the money to the debenture holder, and this will involve cash outflow. So to redeem the debenture, okay, the company may redeem by lump sum payment or by installment. Depend on the question that you will get later on. So if the company want to pay by lump sum, meaning they will settle all the debenture that they borrow. If they want to pay by installment, meaning they will gradually decrease the loan, okay, in the company stage by stage. So let us look on the next part. Okay, the debentures may redeem at at three different conditions. Okay, number one, you may redeem at a discount. Redeem at discount meaning you are going to repay the amount lower than the issue value. And the difference is called the discount on redemption. The discount on redemption indicates gain to company. Okay. However, the standard require the discount to be amortized over the term loan. Number two, the debenture may be redeemed at an amount higher than the issue value, meaning you are paying greater than what you borrow. So the premium is considered as expense to the company. And again, the company also require that the premium is to be amortized over the term loan. Or you may make the redemption at a price equal to the issue value. So this is what we call redemption at par. So you only pay what you borrow. Okay, the journal entry to record the redemption or debenture is only this step. Okay, so how to make the redemption? You just debit the debenture value and credit the bank account with the same value. So if you want to redeem at 100,000, so the payment will be 100,000 and that's all. Okay, this is the only step how to make the redemption of debenture. It's like you are paying the bank loan. Remember in part 1, when you make a payment for your bank loan, you will debit the bank loan and credit the bank. Similar as debenture, when you make the redemption of debenture, meaning you are refund back the money to the debenture holder. You are paying back the amount of debt that you borrow. So you just debit the debenture and credit bank. You don't have to replace the value as what you have done for redemption of preference share, because redemption of preference share is um, bound to the requirement of the statutory act where you have to ensure that the redemption of preference share may not lead to the reduction in the capital. So that is why you have to replace back the capital. But as for debenture, there is no requirement by the statutory to replace back. Okay, so let us look this illustration. Okay, Manjung Berhad issued 50,000 3% debenture on January 2005 at par. And the prevailing market interest rate is 6%, meaning 6% is the market value or the effective interest rate. At 3 years later, the company decided to redeem all the debenture above the issue value. Okay, you start borrowing this debenture on 2005. 3 years later, you want to redeem the share, meaning at 2008, you are going to settle the share, the debenture. And you are going to redeem by lump sum because you want to redeem all, meaning you are going to redeem by lump sum. You are going to repay all of the amount that you have borrowed. So you are going to redeem above the issue value, meaning you are going to redeem greater than 50,000. You borrow 50,000, right? But later on, after 3 years, you are going to redeem at above the issue value. But the amount is not given. You are required to discuss the accounting treatment. So what you need to do is that, this is the answer actually. You are going to debit the debenture and credit the bank. However, okay, the amount is not given. In this case, the amount is not given. So, how to derive to the amount? You are going to calculate by yourself. You are going to calculate by yourself. So, this is how you are going to calculate. Okay, how to get the 56,562. You start by recording on the first year that you borrow. So, you borrow 50,000. Okay, remember, when you make a loan, of course, you have to bear for the interest, right? So, this is the interest. Therefore, you have to pay 3,000. But remember, you only pay what we call the nominal interest rate. You pay 1,500. So at the end, you still have a debt of 51,500. So you repeat the same procedure for the following for the following year until the final year, which is 2008. Because 2008 is the time when you want to make the redemption. Because this is the time where the company wants to redeem all. So after the 3 years, okay, you found that the amount that you need to pay is 56,562. And you decide at this year, you decide you want to redeem all. Meaning you don't want to continue borrow, you want to redeem all the debenture. So how much to redeem? This is the value that you are going to redeem. So you debit your debenture account, all of the value, and then you credit bank. So this is the transaction that shows the redemption of debenture. Is that clear, class, so far? Can you understand the redemption of debenture?
Yes.
Sudah.
Yes, madam.
Okay, very simple. You only have one step, debit debenture, credit bank. Okay, but don't worry, in your real question, this amount, okay, will be given. You are not going to calculate by yourself. This amount usually will be given straightly in your question. Okay, so let us continue the last part in chapter 4. There is share buyback. We also call it as a purchase of one share. Okay, so recall back, still related to chapter 3. In chapter 3, you have issue your shares, right? So you issue your shares to the potential shareholders, and in return, you get the money, right? So the money will be the capital to the company. So what type of share do you issue? One of them is ordinary share capital. Okay. Now, in chapter 4, you are going to buy back the shares. So this share is already taken by the shareholders. But now, you are going to take back the share. So the act, okay, of taking back the share is called the share buyback or purchase of own share. That's why they call it purchase of own share. You are buying your own share for the from your shareholders. Okay. Let us look further in the explanation. Okay, as I mentioned you just now, share buyback is where the public listed company purchase its own shares. Meaning the ordinary shares in the open market, provided it is authorized by its constitution. Again, it is similar to the redeemable preference shares. Okay, the act of the redemption must be permitted or authorized by the constitution. Similar to the share buyback, you must get the permission from your constitution. Okay, why do the company wants to buy back their own shares? One of them is they want to reduce the number of shares in the stock market because they don't want to have oversupply of the share. Because when you have an oversupply of the share, the value of the share will decrease. So when you see the shares are oversupplied, the company will start buying their shares in the market. The reason because they want to reduce the number of shares and they hope that the value will be increased in future. Okay, in addition to that, okay, when they reduce the number of shares, of course, they will stabilize the demand and the supply of the shares. And thus, okay, it will create a favorable impact on the company share price. As I mentioned to you, if the supply is greater than demand, the price usually will decrease. But if you can stabilize, okay, the relationship between demand and supply, so you, in other words, you can also stabilize the price. So the price will start increase, since the supply is lower than the demand. And of course, next is to enhance the earnings of the shares and the dividend payout. So when the value of the shares has increased, okay, automatically the share of the price also will increase, and there will be a potential that the dividend will be higher. And then, of course, it is one of the way for the company to increase their financial resources. Because when the company buy their shares and they have an option to keep the share. So when they found that the market is favorable, they will resell the shares with the hope that they can get gain, okay, in between that. So this is one of the strategy for the company to increase its financial resources. Okay, let us look at the requirement by the act. Okay, according to section 127 subsection 4 of the Companies Act, okay, it allows the company to implement the share buyback scheme. Okay. But okay, you have to follow some of the condition here. Okay, you may buy the shares. Okay, according to the Companies Act, the company may buy the shares. Okay, but they can either to, okay, when they buy the share, what can they do? They can either cancel the share, so purchase, or they can retain the shares, so purchase as treasury shares, or they can do the combination to retain or and to cancel. So this is number one, this is number two, and this is a combination of one and two. Okay. In addition to that, okay, according to subsection 15, okay, just now we are referring to subsection 4, right? Into to the subsection 15, it is specifies that if the company wants to cancel the shares, okay, they must ensure that the cancellation may not be a reduction of the share capital. Again, the provision is more or less the same as the redemption of preference shares, because when you cancel the shares in share buyback, meaning you will reduce the share capital. But according to subsection 15 of section 127, this shall not be happen. And thus, the company needs to maintain its capital. So, if the company choose to cancel the shares, you must be very careful. According to subsection 15, the action of cancelling the shares must not lead to the reduction of share capital. Therefore, you must find a way to maintain your capital. But if you buy the shares and keep it as treasury shares, then um, you are not what to say, comply to subsection 15, because there is no reduction of share capital when you keep the shares. Okay, now let us look at the share cancellation method. Okay, this method is used when the companies cancel immediately shares after its repurchase, and the shares are not to be held as treasury shares. Okay, when company wants to cancel the shares, they will not keep the share; they will cancel the share. This method is called as share cancellation method or share retirement method, which may be suitable for company that has extra funds, meaning they don't care to keep the shares because they still have extra funds there to back up for their transaction. According to subsection 13 of Companies Act, okay, require that when own shares are purchased and cancelled, the cost of the share purchased by the public listed company must be made wholly out of company's retained profit. Okay, meaning that when you want to cancel the shares, remember just now you have to maintain back, right? So how to maintain? According to section 127 subsection 13, okay, you may replace back the share by using your retained profit only. So you don't have many option. You only have one option is to maintain by using your retained profit only. So how to maintain the shares? The cost of the share buyback should be backed by an equivalent amount of the retained profit. It's more or less that redemption out of profit. Okay, let us look at the journal entry. So this is the first step. Okay, to cancel the shares purchase, you are going to debit your ordinary share. Debit ordinary share meaning you are going to cancel or to reduce the share. So the share has been reduced by this value. This is the cost of the shares purchase. Cost of shares purchase. And then step number 2 is to make the payment. Okay, when you cancel the shares, when you buy the shares from your shareholder, you cancel and then you pay the payment to your shareholders, because you already buy the share from them, right? So you need to pay the share. But remember, okay, subsection 15 says that, okay, the cancellation must not deemed to be a reduction of the share capital. So you need to replace, right? So how to replace? According to subsection 13, the replacement can be done by wholly out of company's retained profit. So this is how you are going to maintain or to replace the share. Okay? Sorry, replace the capital. How to replace? You debit the retained earning or retained profit account. Debit meaning you are going to take out the money from the retained profit and transfer to the ordinary share capital. So the amount will be increased with the same value. Very simple. You just use one method only. Okay. You just take from the profit. Is that clear, class? Is that clear?
Yes, madam.
Yes,
So
madam.
if the company wants to buy the shares, okay, you look for the option. Either they want to cancel, they want to retain, or they want to use combination. Meaning they want to buy 100,000 shares, they want to cancel 70,000, and the 30,000 will be retained as treasury shares. Or they will cancel immediately the 100,000. Or they will keep all the 100,000 and keep it as a treasury shares. Depend on your question. That is the first thing that you know. You need to know. Okay. So if you are choosing to cancel the shares, then you have to follow the subsection 15 and subsection 13. But if you want to keep the shares, then it's all right. You don't have to follow. You don't have to bind with other requirement. Because when you keep the shares, meaning you are not reducing the share. The shares are still there. It's just that you are separate it in other account only. Okay, I hope you clear on that. So this is regarding cancellation of shares. So let us look at this example for a while. All right, this is the balance of Sipute Berhad as at 30th June 2000 year 5. So what the company plan to do is that the director has suggested to company to embark a share buyback. They want to embark into share buyback scheme. So they decide to buy back their 2 million ordinary shares at a price of RM1.50, and they want the shares to be cancelled. So we are actually referring to this share. This share. You want to buy back. How many unit? You want to buy back 2 million at a price of RM1.50. And what you need to do with these shares? You are going to cancel the share. Remember, when you want to cancel, you have to maintain back the capital. If you want to cancel the shares, then the next step, you must maintain the capital. So how to maintain? You only have one method, that is to be taken out of retained profit. Okay. So let us look at the suggested solution. This is the guideline. The first step, as I mentioned, you must determine the number of shares you want to purchase. Okay, 2 million. You already identify that. And then determine the purchase price. Okay, RM1.50. And then determine the method upon purchasing. That is cancellation. Okay, this is the answer. Okay, first you cancel the share. How to cancel the share? Debit the ordinary share. Because when you debit, you will reduce the share. How much? This value. 2 million unit times RM1.50. And you credit to a temporary account called purchase of own shares. Okay, the second step is you must make the payment. Remember? Okay, when you buy the shares, you are actually buying from the shareholders, right? So you have to pay them. You have to pay them. So the second step is you will pay the shareholders with the same value lah. Remember, now the shares already cancelled. The shares is no longer in the company. So you have to replace the shares. How to replace? Okay, you just only one step. You only have one method. So you are going to take the same value from the retained profit and transfer to the ordinary share capital account. So now you have replaced back the capital. Is that clear, class, so far?
Yes, madam.
Okay, very easy, Alright, so this is the statement of financial position. You just have to adjust. Okay, recall back. Okay, you have transaction regarding bank. Credit meaning you have to decrease. Okay, so that is why here you minus. As for the ordinary shares, okay, you have transaction. Okay, number 1 here, decrease. And then number 2 here, increase. So you have two transaction related. Okay, number 1, this one you have to minus. Actually, tertinggal ni. Okay, minus. So decrease. And then this one, increase. Okay, preferences remain the same. Okay, there's no adjustment regarding preferences. So remain the same. Last one is the return profit. Yes, you have transaction related to return profit here. Debit meaning you have to minus. So you have to minus. So this is the closing balance, the current one, the adjusted one. Okay, based on our journal entry just now. Okay. If you ask me, madam, how to prepare this statement of financial position, actually you just have to go back to the question. This is the original one. Okay, this is before the adjustment. So what you need to do is that you just need to take all this balance, okay, this whole balance, and then you have to adjust lah. You have to adjust according to the journal entry here. Okay, you just have to adjust according to the journal entry here. And that is how you have this new balance. Okay, last but not least, okay, treasury shares method. What about if company don't want to cancel? So this method is used, okay, when the shares repurchased by the company are not cancelled. So if the company don't want to cancel the share, they can keep the share. And when they keep the share, they have to keep it in a separate account called treasury shares. Treasury shares indicates that the company will reissue this share in the future. So remember, there are two methods here. The first one, you buy the shares and cancel immediately, meaning you are going to write off the shares. But the second method, you don't want to cancel, but you want to keep the shares because you have an intention to sell the share in future. So you have to keep it in a separate account called treasury shares. And please take note that the owner of these shares have no right to vote, has no right to receive dividend or to participate in any distribution. So the journal entry will be as follow. This is only the journal entry. Okay. When you buy the shares, debit treasury shares, credit bank. You still need to pay because you are buying the shares from the shareholders, right? You still need to pay them. But the shares is not to be cancelled, but you keep it in a separate account called treasury shares. So very simple. This is only a step. Okay, let us look at the presentation of the treasury shares. Where to record the treasury shares? Okay, first thing you need to know, treasury shares are not an asset. As such, in the statement of financial position, the treasury shares are to be set off against the equity at its current value, and it is considered part of unissued share. Okay, now even though you debit the shares, but this is not your asset. This is not your asset. So what you need to do is that you need to present it as part of the adjustment to the equity. Okay, this is your equity, right? This is your equity. Okay, this is your equity. So after you have record your equity, that is the issued and paid up capital and reserve. So you are going to adjust the treasury shares against the equity. So how to do that? This is how you're going to present. You less, okay, the units of the treasury shares, if any, and its carrying value. The carrying value is the value in ringgit Malaysia. Okay, so this is how you present the treasury shares. You are not going to minus, okay, you are not going to minus here. No. Okay, if you cancel the shares, yes, you have to minus. But since you are not cancelling the shares, you still want to keep the shares. So what you need to do is that you need to separate the shares to account called treasury share. So the way to disclose the treasury shares is by adjust it according to your equity. So let us look the example here. Okay, using the information in example 13. Okay, where does the example taken from? Okay, this is actually taken from the example of this, sorry, where the issuance of share. Sorry, this one, the cancellation method here. This is, we are actually referring to the same example. But now, okay, we assume that the shares purchased are not to be cancelled, but they are going to keep as treasury shares. So we are going to use the same example. Company wants to buy the 2 million ordinary shares at a price of 50 cents, but the shares are to be kept as treasury shares. Right. So this is what I meant just now. You are required to prepare the journal entry and the extract of the statement of financial position. Okay, let us look together how to prepare. Okay, as usual, determine the number of shares to be purchased, determine the purchase price, and determine the method. Okay, so now we will have different method because we are using treasury shares method. So the answer will be debit treasury shares, credit bank. By how much? Okay, you take the amount of the shares to be purchased and to be held as treasury shares. 2 million unit times with 1 ringgit and 50 cent. 3 million. Okay, same but you don't cancel the share. You keep it as treasury shares. So this is the carrying value of the treasury shares. So in the statement of financial position, okay, first thing, of course, you have to minus, okay, because in the first adjustment here, you credit bank, credit meaning will be an outflow or reduction. Okay, you minus here. And then the ordinary shares still maintain the same. Preference shares also still maintain the same. Okay, retained profit also maintain the same. However, okay, there will be adjustment for the treasury shares. So how many unit of treasury shares? 2 million unit. How much is the carrying value? 3 million. So you are going to minus this from the total equity. So your total equity from 26 million become 23 million. Okay, class, that's all about the treasury share. Do you understand?
Yes, madam.
Okay,
Yes.
I hope even though you cannot grab all, okay, but I hope you can see the difference. What if the company cancel the shares and what if the company keep the shares? The difference here, one of them is on this part. If you cancel the shares, then the value of the shares will be reduced because when you cancel, the shares will be reduced. Okay, and at the same time, your retained profit will also be reduced. Because why? Because when you cancel the shares, okay, you have to follow the Companies Act where you have to maintain back the capital. Okay, so these two accounts will be affected. But if you want to keep the shares, okay, what happens is that your ordinary shares account will not affected. Similar to retain profit. Because you don't touch anything, okay, you don't cancel, so you don't have to replace. But instead of that, you are going to create another account called Treasury shares, and it need to be adjusted from your total equity. Okay, your equity consists of either issued and paid capital and reserve. This is your equity. Okay, very simple equity for treasury shares. Okay, however, okay, there is additional transaction here. Please be very careful. Sometimes, okay, the question may want you to resell the treasury shares. Remember, when you want to keep the shares, okay, there's a reason why do you want to keep the shares, kan? Why company wants to keep the shares as treasury shares? Because they have an intention to reissue the shares in the future. So what happens if the company wants to reissue the shares after they have keep the shares? So this will be the additional transaction. So you are going to assume you are going to reissue your treasury shares in the open market when the market is improved. So the difference between the reissued, okay, the difference between the reissued or the resale price and the carrying value of the treasury shares should be adjusted to or against equity. Okay, so when you want to buy your shares, okay, you have to be very careful between these two value. Okay, the reissued, the resale price versus the carrying value. Okay, versus the carrying value. Okay, assume that when the reissued price is greater your carrying value. Okay, when there is a difference, okay, we are going to look which one is greater than which. When the reissue price, okay, the resale price is greater than the carrying value, actually you have gain here, class. You have gain. You untung sebab you jual lebih daripada apa cost yang you ada. So the gain, the difference or the difference ni will be transferred to the ordinary share capital. Let's say the reissue price is RM2, the carrying value is RM1.70. So amount that you receive RM2, right? Okay, the cost is RM1.70. So where do you record another 30 cent? Is to transfer to the ordinary share capital. This is what we call should be adjusted to equity. Equity refer to ordinary share capital. But what about if your reissued price is lower than your carrying value? Meaning that your reissued price, let's say only RM1. Your carrying value is RM1.70. So you will only receive RM1, but the cost is RM1.70. So the difference of 70 cents is considered your loss. This is the difference. So the loss will be transferred to your retained profit. So here retained profit is your equity here referring to your retained profit. So if you have gain, you transfer to the ordinary share capital. But if you have loss, you have to write off against the retained profit account. Okay, so let us look this example. Okay, we are still continuing the information from example 14. Now we assume that the director decided to resell the 2 million treasury shares in the open market at RM3 per share. So how to find the value, how to record the answer? First, you need to know the number of shares you want to resell, 2 million, and the reissue price, RM3. Next, you have to find the difference between the reissue price and the carrying value. Okay, how much is the carrying value just now? The carrying value of the shares is RM1.50 kan? You are buying at RM1.50 kan? That is the current value lah of the shares. But later on, when you want to sell, you can get at RM3. Okay? So the difference is 1 ringgit and 50 cent. Because the reissue price is 3 ringgit, while the current value is 1 ringgit and 50 cent. So the difference here will be 1 ringgit and 50 cent. Meaning you have gain here, you have gain. So remember, when you have gain, the difference will be transferred to ordinary share capital as follow. So when you resell the shares, when your reissue price, okay, this is when your reissue price is greater than your carrying value. So the amount that you receive from selling the share is 6 million, while the cost of your shares or the carrying value is 3 million. So you have a gain by 3 million here and you transfer to the ordinary share capital. Okay, is that clear, class? Can you follow me?
Yes, madam.
Do you understand, okay, the difference between reissue price and carrying value? Do you know how to find the difference?
Yes.
Carrying value is the original cost of your treasury shares. Reissue price is actually the selling price of the shares to the open market now. Okay, so this is the adjustment in your statement of financial position. So increase here because you have debit the bank just now. Remember, debit the bank, increase. Okay. Treasury shares, you credit. Credit meaning you reduce. Ordinary shares, credit meaning you increase. So let us look at the adjustment together. The ordinary shares. Okay. It's no longer nampak. Just now kan, you have this transaction kan. Now, it's no longer in your account. Okay, no longer. Okay, for the ordinary shares, yes, you have increase here. And that's it. Preference shares, there is no change. Maintain. Retain profit, also there is no effect. You only have 3 accounts. You only have effect on these three accounts. Okay, so that's all about the reissue at a price greater than the carrying value. So the rest you can do by yourself. Okay, you can look at your study guide. These are the additional example that you can refer in your study guide. Okay, so that's all for today. Okay, do you have any question to ask, class? Do you have any question to ask?
No.
If not, I'm going to stop the recording.